All right, good afternoon, everyone. I'm Steve Haskell, and this is The Exchange, your RealtyMogul resource for 1031 market intelligence and education. And today we have Warren Thomas on for a third time. And this will be a treat because we're going to be talking about a lot of the misconceptions pertaining to net lease real estate, often referred to just as triple net. And Warren is a great person to go to for these types of questions and topics because he owns billions of it, or at least his company does, which is Exchange Right. And I'm going to get to that in a second. But before I do, we got to start off like we always do, going over some of the risk disclosures. So let me share that with y'all for a second. All right. So everybody, um, please look over the risk disclosures. Basically, what this is saying is that we're not giving any investment advice on this show. What we do offer at RealtyMogul, they're private securities. They're not liquid. There is risk involved. You can lose cash flow. It's volatile. This is real estate. Your principal can go up or down or be lost altogether. So make sure you consult with a financial advisor, your CPA, your tax advisor, your legal counsel, and your family members before you make any investments. And if you are going to make an investment, make sure you look over the private placement memorandum. Okay, that's going to have a lot of the information pertaining to the potential investment, the ones that RealtyMogul offers. And Warren Thomas's company Exchange Right puts together and syndicates and offers to folks like us. And we're a member of FINRA and SIPC. And so we're regulated by those entities. And so we must comply with the regulations they provide. Anyway, so yeah, make sure, just keep in mind that these all have risks. Past performance isn't no guarantee of future returns. And with that, I'm going to stop sharing this screen and then talk a little bit about something more interesting, like Warren here, who is a managing partner and co-founder of Exchange Right. Now, this is always a great one to read off of, especially when we get to the end with all your licenses, Warren. But
You
Warren
bet.
Thomas co-founded Exchange Right 2012, growing it into a leading provider of diversified real estate DSTs and REIT investments, serving more than 8,900 investors. Under his leadership, the firm has grown to 6.3 billion, actually over that, in assets under management, diversified across more than 1,300 properties in 47 states. All exchange rate offerings have met or exceeded cash flow projections since the company's inception. Well over 40 years of experience as a CPA and over 30 years as an active commercial real estate investor, Warren specializes in tax-efficient investment strategies, estate planning, real estate advisory services. He holds a bachelor's in business from Biola, master's in taxation from Golden Gate University, and maintains a Series 6, 7, 22, 24, 39, 63, 66, and 79 securities license. Warren, welcome to the show. Thanks for being here.
Thank you.
Yeah, that's quite a tale you have there on your introduction, Warren, and probably one of the reasons why you guys are so successful over there with all the experience you had, particularly with the focus on triple net real estate, which is what we're
Yes.
talking about today. And I know we were talking a little bit before. We come across a lot of investors that are trying to retire and go passive. And one of the things that their brokers tell them is, hey, why don't you try triple net real estate? It's mailbox money. But I've sold close to somewhere between 600 million and a billion of this type of real estate and syndications. And I know you've actually managed billions of dollars in this specific asset class. And we both know that that's just not the case. So why don't you explain to our audience a little bit about what net lease real estate is, what triple net means, and some of the misperceptions that a lot of folks have when they're considering this option?
Yeah, perfect. Thank you, Steve. A little bit on the triple net space or the double net space. Net lease real estate is a type of real estate where you're buying it, and the tenant that's inside that real estate that's occupying that building is actually on the hook not only for the rental contract that we have, and often these rental contracts start at 10, even 20 years in length.
All right, sorry, folks. So I'm going to go into this a little bit and see if we can get them back. But when it comes to net lease leases, triple net, often double net, is they can extend typically between 10 to 20 years. And in 10 to 20, and so a lot of people think, well, hey, 10 to 20 years, we're going to get these checks. And the tenant is responsible for the insurance, they're responsible for the property taxes and the maintenance on the building. All right. So where'd you, you
Yes,
back, Warren? Okay.
under the net lease properties, the tenant is responsible for insurance, for taxes, for increases in the repairs or maintenance costs. All of those costs are borne by the tenant. And with a good net lease contract, you also have bumps in the rent, and you have a stable and reliable corporation behind the rental contract.
So, Warren, maybe we'll catch you next time then, and I can take it from here then. All right. So, the long and short of a lot of the misconceptions that I see when people are considering triple net is they think that it's just mailbox money because they're told a few things. They're told that the tenant is going to pay the property taxes, the maintenance, and the rent, obviously, and the insurance is on the building, which ideally is great. And when it all works out, that's fantastic. It really is mailbox money when it all works out. You just get a check typically once a month. You don't have to deal with the tenant's toilets and trash, because the tenant is dealing with all of that. And then when you have a really strong tenant, typically one that's considered credit rated, then the only way that they're legally not going to pay rent is if they go bankrupt. And if they're credit rated, the chances of them going bankrupt is extremely low. So people like that. People are like, hey, how about those well, it used to be Walgreens, right? How about those Walgreens, or how about those Amazons? How about those different large companies that people are looking for to back their leases that have a rating from a big bond lender or credit company. The big ones that you're going to hear are Moody's, right, or S&P rating. So those are the big bond rating companies, and they're going to look through the balance sheets and the books of these companies, and they're going to rack and stack and give it at different levels, which indicate how strong their balance sheets are and the likelihood of them paying their debts. So you're going to have whatever it's AAA, AA minus, B, triple B. You're going to hear those types of bond ratings, and they're going to mean different things for whether it's Moody's or S&P or another institution. Okay, so really what a lot of people look for is they're going to say, hey, I want something more than a 10-year lease, and I want a company with a really good bond rating, what we also call credit worthy, and I want it to be absolute triple net. And those are the things they look for, right? And so then what's going to happen is their brokers pull up a sheet of all the different properties all over the country, and then they're going to just kind of go through those books and pick one. And the tough thing is they're not all created equal, and they're not all as they seem. And so I'm going to talk a little bit about some of the issues that might pop up. We'll start off with just the idea of a triple net. So there's different styles of triple net, right? They don't all mean absolute net lease. Sometimes there's little carve outs in the lease, or there's reimbursements. So what do I mean by that? I'll tell you a story. So back in the day, my boss had a client that owned a grocery store, and it was a large national company, and she had a triple net lease on that building. Well, it actually was her husband that bought the building. He passed away, and so now she owns it. So she goes in and she looks through all the books and she sees the checks coming in, and everything seems to be going fine for the first year that she's managing everything. And then the second year she notices, oh, she gets a statement in the mail from the IRS saying that she owes taxes. Actually wasn't from the IRS, it was from the county. She owes property taxes. Like, well, I thought the company pays for the property taxes. No, the company doesn't pay for the property or taxes you pay for the property taxes as the owner, and then the tenant is going to reimburse you. That is how this triple net works. She'd even know it. The broker didn't tell her husband, and oftentimes that's something that pops up. And sometimes a broker will say, you know what, it's okay. The tenant's going to cover it. They're a good company, they're bond rated, and they're legally obligated. Well, in this person's case, we'll call her Betty. Betty ended up having to chase down her reimbursement by calling phone trees throughout this big national level grocery stores phone tree for days and days and days. And no one knew how to cut her a check, and no one was willing to help her out. Now, she usually ended up getting paid months and months later, but she ended up even having to go take out loans to pay down those expenses before she was reimbursed. And so that was happening year after year. And then she finally ended up coming to a company like ourselves to sell the building and do a 1031 exchange. And so now the moral of that story is triple net leases aren't all made the same, right? There's little carve outs, there's little reimbursements. You must have an attorney review the leases. Okay. You must do what's called an estoppel and a lease audit. Make sure there's no out clauses where the tenant can get out early. Make sure there's no little reimbursement things in there, and then make sure that everything's covered, because there's often little items in there that aren't covered that you're not aware of because it didn't come out during the discussions or a summary or the OM you can read over. So make sure you have a really good attorney to look through that for you. Now, in addition to all that, a lot of people kind of walk away from double net leases. Well, once you get to as a sophisticated buyer, we oftentimes like double net leases because you can get them for a little cheaper. The market doesn't pay as much for a double net lease as a triple net lease oftentimes. So what can happen is the um, the buyer can buy a double net lease, then take advantage of the resources that they have and also the access to insurances that they have and maintenance, or they can, and then they can make up for that and get virtually a triple net style property. And I'll give you an example. Oftentimes, the building is a double net because the roof and the parking structure isn't isn't covered in the triple net package. So it's a double net or some version of that. Well, the buyer can either go out and get warranties, they can go out and get insurances, they can go out, they can escrow money and put money into reserves and ask for the seller to put money into reserves in order to take care of any future issues that might pop up. And so, virtually, from a risk profile, they're kind of getting a triple net style investment, but at double net prices. So when you're working with a sophisticated institution and a sophisticated buyer like the ones that we work with, like Exchange Right, and many other sponsors that we work with, well, you can take advantage of some of their scale and some of their expertise to get better deals than a lot of the folks get on their own. So that's some of the misconceptions I want to talk about when considering a triple net property. Now I want to talk about some of the misconceptions of buying and acquiring a triple net property. I notice a lot of the folks that I talk to when they are considering buying triple net and they're doing their due diligence, they actually do a very surface level due diligence process, and they oftentimes look at a lot of the wrong things. So when our institutions go out and buy net lease real estate, they're they're typically executing a long laundry list of items, whether it's looking through and paying for zoning, estoppels, engineering reports, environmental reports, phase one and phase two, okay, various inspections. They go through a lot of these items, right? They have lawyers look through the leases and make sure that there aren't any of those out clauses and things like that, because that could potentially lower the value of the property when you sell. I've heard horror stories of people that did not do environmental surveys. They found out there was an oil spill a long time ago, or there was a rock quarry or something next to the property. There was railway ties. before that poison the soil, different things like that. That if you don't know net lease real estate and you don't understand how the market is valuing the real estate, might significantly impact your return on investment when you sell. Okay, you might be overpaying because you didn't find that little detail in the environmental report, or you didn't decide that you needed to go out and do a phase one or a phase two environmental survey. All right, so just something to be aware of when doing your due diligence, because a lot of folks that I talk to, they say, oh, I'm just going to go buy a Dollar General somewhere, and then I'm going to get my 6, 7, 8% cash flow. And I don't really care where it is or anything about it because Dollar General guarantees that lease, and they're a big company and they're probably not going to go out of business. And so at least I'm going to get paid for 10 years. Well, that's one way to look at it. But as I just went over, there are definitely due diligence items that you should do. So make sure you partner up with a good lawyer, a real estate lawyer that does this for a living, or an advisor that can help you through the process, or come do a syndication, work with a group like ourselves at RealtyMogul, where our due diligence goes through all the sponsor reports. We go through their analysis, and we try to look for those red flags on behalf of our clients so we can help identify them. Now, you can never mitigate all the risk. You can never get rid of it all, right? But just by going through all the third-party reports, by doing sales comps in the area, by looking at the leases and looking at the tenant and their business plan, you can mitigate quite a bit if you know what you're looking for. Okay, now I want to move on to the third phase, which is misconceptions when managing the real estate. And then actually, I'm going to add a fourth section called misconceptions upon exiting net lease real estate. So when managing the real estate, a lot of people think that it's mailbox money, but what we've seen in the past is, yeah, that's just not the case, even from a legal point of view, from an operational point of view, or otherwise. So, for example, during COVID, there were a lot of, not a lot, we ran into some major institutions that decided, heck, you know what? We're going to take advantage of this situation and not pay our rent for a while. You think, well, Steve, how do they do that? They're legally obligated. Well, COVID created a lot of confusion. The courts were backed up for months and months and months. So a lot of these institutions said, hey, landlords, we're not going to pay rent for a few quarters, and you can come after us. And then I'm guessing what their idea was, because we never got that far, because our sponsors, the people we worked with, they have, a lot of them have lawyers on staff, on payroll, that can go out, write letters, threaten litigation, and so forth. And they did so, and a lot of them were able to get the tenant to start paying, and they just said, no, you are paying us, and they continued to pay. But a lot of the smaller mom and pops that don't have those types of resources, well, they had to figure out a way to pay their expenses and to pay their mortgages without getting rent for a few months. I assumed that the companies eventually came back because a lot of them were having the best quarters they've ever had during COVID, especially ones with drive-throughs. Okay, so something to think about. Even though the law requires them to pay their rents, doesn't mean they will. All right, so the next thing along the same lines is maintaining the building. A lot of the tenants are required in their leases to maintain the building to a certain standard. Doesn't mean they will. And I have seen cases where tenants have walked away from buildings at the end of leases, leaving it in disrepair. And then they simply say, come after me, come sue me. And a lot of these mom and pops that own these buildings just don't have the resources to do that. So when you're managing triple net properties, it's a great concept. And when everything goes well, it's fine until it doesn't. So you have to make sure, if you're going to go buy on your own, you have to decide what are you going to do if that tenant decides not to pay rent, not to pay an expense, not to maintain the building, and they're going to mess with you. Because Here's the thing, they're not your friend. They owe returns to the shareholders. That's who they are working for. They're not working for you. In fact, they often have staff of real estate attorneys that are making sure that they are not paying you anything they have. They're paying you as little as possible as the landlord. Okay. So keep that in mind. All right. Now, as far as managing property, let's go over a couple more things. One is releasing that building if that building disappears or if the tenant disappears. They could go leave the property or they can go bankrupt or the lease can end, right? And so at that point, you got to get to work because at that point, it is a lot of work. So usually if a tenant leaves a building before the lease is over, well, you do a couple things, but they're still obligated to pay the lease legally. So you should theoretically still be getting money. But there's a couple issues that you need to be aware of. One, leasing agents evidently cost a lot of money, I found out. And you have to have a lot of money in reserves in order to pay those to show those leasing agents that you can pay their commission. Also, typically, those net lease properties are, if you're trying to release them, you're going to have to spruce them up. And when you've got a $6 million property, $5 million property, because typically that's what the price range is before net lease and triple net start to get quality is 4 to 6 million bucks maybe. Well, you can sometimes be being paid, you could have to put into the building sometimes 20% of the price you paid for it in order to get it into a position to take on a new tenant, right? With all the tenants improvements that they're going to require. And oftentimes you have to provide different concessions to get them into building depending on the market, right? So that's really important. Like, don't just, that's what happens if you just buy out in the boonies because you have a Dollar General or another tenant that's really strong. It's going to give you really high cash flow. Well, if they ever go dark or they don't renew the lease, it could be very expensive to get a new tenant into an area that doesn't have a big draw and a lot of demand and might have low vacancy. Okay. So make sure you have cash on hand in order to reposition your asset if you're in a triple net, if you own a triple net building or a net lease building, whether you're towards the end of the lease or earlier on in the lease. If that tenant leaves or goes bankrupt, you could be in trouble. And if there's a loan on the building and the tenant leaves the building, well, then the bank is probably going to cash flow sweep the revenue. That means the bank is going to collect all of the money and put it into a lockbox, right? And you're not going to be able to touch it until you get in a new tenant into that building. And then on top of that, the bank is most likely going to require that tenant to be equal or greater in a credit rating or in quality, right? So they're going to be able to decide most likely who you put in that building. So if you have a Dollar General or someone like that and they leave and you want to put in Joe's Motor Repair, well, they're probably not going to let you do that. And so meanwhile, you're paying interest on that mortgage, right? And or the bank is cash flow sweep the revenue and you're not making any income at that time. So some things to definitely think about when managing the property. Okay. Um, let's see. Oh, by the way, I have seen sponsors do some pretty Herculean movements in order to save properties like that, including working with local and state government to find tenants, working with large banks because they typically their lenders are lending on lots of their properties, so they have good relationships with a lot of these entities and where they're incentivized to maybe provide a little slack for a lot of these sponsors with a property that may be struggling. Whereas a mom and pop, the bank is probably not going to be helping you out if you have one $4 million property, $5 million property that you're trying to, that they have lended that they're lending against. Okay, um, especially if it's a commercial bank, they're probably not going to try to be your friend and help you get through that. But maybe they will. Maybe they'll get lucky. All right, so those are some of the issues with managing net lease and triple net. Now I want to talk about exiting the property. Okay, Exiting net lease real estate is tricky because multifamily typically, historically, appreciates a little bit every year. So ideally, your property is going up in value as over time. Therefore, if you need to sell the asset, a lot of times with residential, you can get away with it. You need to sell an asset quickly. Multifamily, there's typically pretty strong demand. There's lots of different buyers for it, and the property appreciates over time. You've been increasing rents with inflation, hopefully, and you could be okay theoretically. Net lease, the value of that property is different because it is going to correlate directly with the remaining duration of the lease. So the value of the building correlates with the remaining duration of the lease. So if you have a 10-year lease, that is probably the highest value you're going to have in that property. And as that lease burns down to 8, 7, 6, 5, 4, 3 years left, well, that price is going 6, 5, 4, 3, $2 million, and it keeps going down because a lease with 1 year left at Dollar General is a lot cheaper typically than one with 10 years, right? So the getting a solid return on investment is contingent upon negotiating at that tail end when you're renewing that lease. When you do that, you often have to give a drop in value or a drop in rent and some concessions, maybe add some capital to the building to spruce it up a bit in order to incentivize the tenant to stay, especially if they're a really strong tenant. All right. So, some things to be aware of there. At the end of that lease, you have to be ready to have attorneys on hand and you have to have a plan to negotiate with that tenant. And again, I've heard horror stories of my own clients that went out and bought a certain type of triple net property on their own, and the tenant didn't renew the lease after 10 years. Came back, they sold their property for about 40 cents on the dollar, and that's 10 years later. I've heard of one client of mine that had a certain type of convenience store with a big tenant, and they had a very tough legal team. And 10 years later, I think it was 10, don't know for sure, that legal team comes in, negotiated rents, and cut the rents in half. So the rents were half of what they were 10 years ago. And the reason that they were able to do this was because there was a loan on the building and they didn't have much room to negotiate because if that tenant left, that building was going to be worth a fraction of what it was worth before, and the tenant was probably going to have a very difficult time, or excuse me, the landlord was going to have a difficult time finding a tenant that was as strong as the tenant that was currently in the building. So the bank probably would not let them re-tenant that building most likely, um, or the building would be worth a lot less if you were to get a weaker tenant in there than having that strong tenant. So it gets complicated, right? It's not just mailbox money, especially at the end of that lease. That's why a lot of our clients choose to 1031 exchange into a DST from their residential properties rather than to go buy triple net on their own. Okay, because if things go wrong, you could potentially lose the asset completely. And even if it's debt free, you're buying a Dollar General or something debt free. If that tenant leaves, you're probably going to have to cough up a lot of cash to reposition the asset and then work pretty hard to find a new tenant. Okay. So that's some of the misconceptions when selling a net lease property and renegotiating. So that's often called, if you ever ask around, that strategy to increase the value in the property is called a blend and extend, right? They usually offer concessions or lower rents a bit in order to get a long-term lease, and then that's when you sell it. Okay, blend and extend with that brand new 10, 20-year lease that you just slapped on that property. All right, but it usually takes a little bit of skill. It often takes a lot of capital and experience to be able to do that. And in fact, a lot of the institutions that I work alongside and talk to, they actually don't even like 10 to 20-year leases because they say that crystal ball is too hazy. I can't see 10 to 20 years out. I don't know who this tenant is going to be in 10 to 20 years. If this tenant loses their credit rating or goes down in quality, well, that could lower the value of my building. I don't know what the market is going to be for these types of leases in 10 to 20 years, but I do know what it's going to be in 3 to 4. At least I have my crystal ball is a little clearer in 3 to 4 years. So a lot of these larger institutions like to pick up these shorter leases with tenants that they know and they know what they look for and they know how to negotiate with. And then they just extend them, then flip them to retail investors that often may not know what to look for, and they make a lot of money that way. All right, so some of the things we went over is the misconceptions of a triple net lease, especially comparing it to double net leases. So just because you hear triple net lease doesn't mean it's actually triple net mailbox money. Have a lawyer review the lease. All right, we looked at misconceptions of buying triple net. They're not all made the same. Make sure you do your due diligence. Make sure you speak to attorneys and brokers, advisors that are experienced in it, because there's definitely some tripwires that you need to avoid there. And then managing triple net real estate, net lease real estate. There's definitely things that you could run into. It's great while everything goes well, but when things don't, there's major headaches and usually very expensive headaches. Then misconceptions when selling real estate. Make sure you're prepared to renegotiate that lease. And maybe you are good at it, but are your heirs? Is your spouse? Are your kids? Are they going to want to take on that responsibility? So, just some things to think about. I hope everyone found that helpful. For if you have any more questions or want to discuss how we buy net lease real estate, give me a call. My name is Steve Haskell. My cell is 760-533-7820. And you can email me at Steven, that's with a PH, Steven.Haskell, Haskell, at realtymogul.com. Or talk to your local real estate rep or Realty Mogul rep that you've been working with and talking to. They can help you out and they can connect you with me as well. I really appreciate everyone listening in to this afternoon, and I hope you have a wonderful evening. Again, this is Steve Haskell, and this is The Exchange, your Realty Mogul resource for 1031 market intelligence and education. I'll see you next time.